Okay, where are we now? We are the 16th. Okay, so we've been looking at this day for quite a while now. This is a triple witching day. Simultaneous expiration of options. That makes usually it's a positive thing in that people are forced in options. You get a certain right to buy or sell stock in the future, and a lot of times all those contracts have to be resolved in one time. So a lot of this is called triple witching. So we expect a lot of volatility today. The next triple witching is in September, and then we have another one in December. So basically, you just have to, if there's a lot of ups and downs today, big movements, you just have to ignore it. We had a Fed meeting day this Wednesday, and they decided to pause the rate hikes. But they have something called a dot plot, which is basically all of the members of the Fed get together and say, well, where do we think the rate should be going up or down? And there was an indication that there could be some more rate hikes in the future. But most likely, we'll show you with charts later on. That's probably not going to happen. It's going to be, this is probably the end of the rate hiking. Let me show you real quick. This is a chart that basically says, how the CPI has been dropping. I think the purple is all items, and then the red is all items less food and energy. So it's been flat for all items less than food and energy, but you can see this. Rent and housing is the last thing to go down, and right now it's dropping. Like we were saying about a month ago, that housing costs were dropping like a rock. So I think this inflation is pretty much cooled. It cooled to 4% this Wednesday. So you can see it's the 11th month of decline. So it's getting under control, and the stock market is kind of digesting all that news and what it means to all the stocks. Now, if there are more rate hikes, there are interest-sensitive stocks. So they'll take a hit, the ones that need to borrow money. And perhaps some of the stocks that are bigger that don't have to borrow money will thrive in that kind of environment where there's more rate hikes. So it seems like inflation's getting under control, and the Fed will stop for maybe 2 more hikes. And that affects what people pay for the multiple of stocks. Let's look at some more of the things on our calendar. We have a holiday coming up this Monday. Usually around the holidays, people are excited, and the stock market goes up around the holidays because people are on vacation. There's not as much volume, and you have good feelings in the air. And we also have the end of quarter window dressing. So we have that's purple, and that's the end here. That's purple. So we have all these things happening that could lead to positive times, but at the same time, we're super overbought. We have never been, of all the time we've been doing this, this is probably the most overbought we've been. Let's look at the stochastics. It's 96. I mean, it keeps hanging on this. There seems to be a fear of missing out in the market right now. Fear of missing out is it's pretty dangerous. It suckers a lot of people in at the last second, and then the stock market goes down after that. So you can't get suckered in to buying at the top. It was at the top last week. We've been in this trading range for a while. We just broke out of that. Whether this is a false breakout or not, I'm not sure. But I expected it to be, going sideways, seeing that the earnings aren't really improving a whole lot. So let's look at today what's going on in the stock market. Right now we're up 0.8%. Okay, look at the S&P, and let's go back to prior levels of resistance. We had a level of resistance right here. That was last week, but we blasted through that. And the next level of resistance is here, which is a fraction more than where we're at now. And then we have a resistance here. And then finally this high we had in January. So, okay, so we let's look at some more things okay, so we have, in our talking points, we have, we're not really paying a whole lot of attention to the 10-year and 2-year anymore because we know the Fed is done tightening. So the, it's not going to be looking at the 2-year to determine anything anymore. So that's not as important as it was before. Let's see. So today is triple witching. Stock options, index options, and stock index futures all expire the same day. And a lot of times it's considered as bullish because people are forced to buy stock whenever they buy a contract for a call. And a lot of people are buying calls these days because the stock market's going up. So as you have these aggressive call purchases, they're saying that this is one of the biggest call purchase times ever. And because of that, today will be a forced exercising of a lot of these contracts. And that could lead us to a slightly bullish or stock market going up. So you see, so inflation is going down. It's getting under control. And it seems like the Fed said it was not going to raise rates in the near future or the next couple of years. That was a big thing that came out of their conference, is that they don't expect to start reducing interest rates for a couple of years. That was really big. I'm surprised the stock market didn't sell off on that. Let me see. Okay, so we have a lot of the 10 big stocks in the stock market, the tech stocks we're following. They've been trading above their 200-day moving average for quite a while. And that's an indication of momentum. But the other portion of the stock market, like the 490 other stocks, haven't been participating, but now they're starting to. So as you have more and more stocks trade above their 200-day moving average, then you have people fearing missing out and starting to jump on, and then you get momentum. And then you have, let me see. Okay, and then you have this uptrend starting again. We break out of this sideways pattern, and then almost all stocks will be in this higher highs, higher lows. Until January of this year, we've been going on a pattern of lower highs, lower lows. So we'll see if we make that turn. But right now the breadth is helping out. It's broadening out in the stock market. Let's look at some of the indexes that are changing here. We have regional banking ETF going down. I don't know what news is causing that, but it could be that the Fed hinted that they could raise 2 more times. Higher interest rates could cause some more stress in this banking industry. That could be why they could feel that for a while more. And also commercial real estate is still an issue with these banking stocks. Retail, home builders. Okay, these are all home builders is affected by interest rates. You have retail, that's affected by the economy. The economy is doing really good. I'm not sure why that's down. Maybe one stock is down. We'll find out later. And a lot of times if one stock goes down a lot, other stocks in the same sector go down. That's probably what it is. Let's look at what's doing good. Gold miners. So gold is doing good. My guess is as the dollar goes down, gold goes up. And that could be the pattern here. I'm not sure. Utilities, is one of the ones that hasn't been doing too good this year. It's a more conservative sector. Oil, energy. Okay, so we can probably determine that oil went up today. Let's look at the CNN pre-market and see where oil is. Oil is probably up today. Let's go down to the bottom. Okay, it's up a little bit. Not sure why. Why it's up some? It's not up that much. Okay, so that's a good reason why oil is up in energy. But we don't have a technology is flat for the day. We just have a pretty crazy day because of options expiration. And a lot of times, like today, this doesn't really have big moves in any real sector. So let's look at some more talking points we have here. Okay, so you can see we're approaching the top end of this higher highs, higher lows channel that we started way back when Walter Deemer told us that we're starting a momentum. Let's look at some of the other sectors that we're looking at. QQQ is basically broken out of our sideways pattern we've been going through for a year, and it looks like it's the top of the channel. So most likely we're going to correct down to here next, and S&P is very similar to that. In the news, why would people on TV say you got to look at all the news that could happen, and the reason they're going to say on TV why it's going to correct? I think the biggest reason is the unknown moves by the Fed. That's kind of the news that everyone will say is why it's going down. The second thing is we have a lot of commercial real estate mortgages. I don't know what they call them, but they're going to ask for more money, and banks might not allow them. There might be some defaults. That could be a news story for the summer. And we know from our weekly here, we know that we're coming into some of the worst months of the year. So it could just be seasonality. They'll say, oh, it's never good in August, never good in September. So that's why it's going down. It's profit taking. So you just have to be ready for that mentally when you're holding. And I'm buying and holding, so I'm just observer right now. Okay, let's look at some of the other sectors. Defense is pretty much sideways. It's in this little tight trading range. It's in the middle right now, and it's overbought. Let's look at gold. Gold, it was going up a lot. Right about here, it hit the top of its range, and whenever the U.S. didn't default on its debt, the safety gold trade wasn't useful anymore. And maybe we do have this higher highs, higher lows. I think this goes opposite of the dollar. So as the dollar goes down, gold would tend to go up. Let's look at consumer discretionary. It's in a sideways pattern. So it seems like we're, until the earnings estimates for a lot of these companies go up, right now a lot of them are flat for the year. Until that goes up, we're in a sideways pattern for most of these formations. And we're at the top for the XLC communication services. And communication services are companies like telephones. Facebook is in there, but they're companies that traditionally have lower PEs and high dividends. So I'm expecting that to stay in this range and not break out. And let me see. Healthcare, I'm surprised. Right now we're like in a sideways pattern, but most healthcare stocks that we're following are in a downtrend. And they're probably because last year they did really good because it was a safety trade, and now these stocks aren't. They have a dividend, they're considered safe, but when everyone's making money in AI-related things, it's not as attractive as an investment. So industrial sector. Um, I have no insight on this. It seems like we're stuck in this little pattern here. The same with the XLF. So I think the majority of sectors in the stock market are going to be going sideways here. Um, Whenever you buy and hold, you have to like this kind of keeps your sanity and to know, in general, if you have a little extra money, you want to buy it towards the bottom of this range and sell or don't buy whenever it gets to the top. You see XLU. Okay, this was one of the sectors doing good today. You can see it is overbought, but it hasn't done as well as it was last year. It's a safety trade. This XLU is utilities, and they pay like a 3 or 4% dividend. So it's considered safer money, but whenever all the tech stocks are going up 30%, no one really is interested in that. Real estate. This is one of the only sectors that is continuing a downtrend and is at the top of the downtrend right now. So it's a pretty dangerous thing to try to jump into that right now. You see, energy. It was one of the best performers last year, and now it's basically flat. And that's probably because the price of oil isn't going anywhere. Oil is like $70 a barrel, and it's not changing. So, you see, energy. Okay. So now let's look at Brazil. Brazil is actually up 20% this year. This was a really good find. It pays a 12 or 15% dividend, and it's a way to diversify from the United States market. And it's well diversified. They pay a dividend, and they I think it's a mix of a lot of stocks, so that are a lot less expensive than American stocks. So it's a very good way to diversify for like 11% dividend. Let's look at uranium. It's basically sideways. It's not very exciting. All right, and let's look at some of the individual stocks. We see that all the drug stocks are like in a downtrend and not really performing this year. This AbbVie is they have a patent cliff, and they're trying to replace their best-selling drug with other ones. So there's this changeover to new drugs, and they're buying companies to replace the one they have now. So that's kind of an ugly process. But all drugs are not doing good today, this year, because no one wants safety trades anymore. But it pays a high dividend, and it's stuck in the trading range here. Let's look at the other stocks like that. Abbott, same thing. It's stuck in the trading range, and it really hasn't done anything this year. Alibaba, I lost track of this a long time ago. It's really hard to predict what's going on with Chinese companies, but it's overbought. You can see that it's overbought. Alphabet, it basically went up like 30% this year. You can see that, I guess, it's still within the trading range, relatively speaking, for the last year. So according to Stochastics, it's oversold. So it's down to 38. 20 is most oversold. So it's like right in the middle. So it's pretty dangerous to buy this right now. You have to wait until you get down to 20 or down at the bottom of this channel to buy that one. Altria, this is becoming like a super reliable stock that trades within a range that pays like a 9 or 10% dividend, 9% maybe. And so I bought this like a long time ago, and it's more than doubled since I bought it because it yields so much. So it's one of my favorites, and right now it's right in the middle. It's overbought. No, it's like halfway. It's halfway between overbought and oversold. So usually you want to buy it down here instead of right in the middle. Amazon's been one of the 30% gainers this year, and it's has a very high PE ratio. So it's a pretty dangerous time to buy an Amazon right now because it ran up so much, and they're not really growing into that earnings. into the price. So Apple continues to go up. It defies logic why it sells at such a high valuation. Not sure why. It could be because people are piling into indexes, and they're 5% of every index. But there's a lot of people saying, why. I think they made an all-time 52-week high right now. So they're almost every stock we're following is, it's pretty maxed out, and it'll probably go down to here before it goes higher. I think because the whole stock market, whenever everyone's bullish and everyone thinks it's going to go up, that's the opposite thing will happen. So you have to be ready for that. AT&T, it's in a sideways pattern. Most of the dividend stocks we're following are stuck in this pattern right here. Bristol Myers, it is stuck in this pattern also. And you can see this year it's making lower highs, lower lows. Almost every drug company we're following is not doing good this year. Colgate-Palmolive is stuck in this range. So is CSX. Meta is defying any kind of everyone's expectations, and it's going up, and it seems like it keeps going up every day. But it's super dangerous to buy that right now. Although it's less expensive than most other companies in the PE ratio, but you can see it's overbought, and we're approaching a really bad time of the year for the stock market. JP Morgan is going sideways too. Microsoft, I think with the ChatGPT news, that is powering this stock higher and higher every day. And today we had a news story that came out with Microsoft. Let me pull to that news story. Okay, I missed it. Okay, there was a news story that came out today. I'll get to it later on. I think Mercedes, or a big auto manufacturer, is using ChatGPT in the car as a new install for vehicles. So that means you can call and make an appointment, make a reservation, talk to the person like they're a carpool buddy. And that is the first application of ChatGPT I saw, and that is major. I thought it was in beta stage, and here they are deploying it in a car. I mean, I thought they were just still trying to figure things out. And if they can somehow beat the other companies to this, AI deployed, if it's ready for deployment, that is pretty big. And that's why I think Microsoft is continuing to make highs. The reason I bought Microsoft in 2010 because I knew that they invested and reinvested into their company to add value. They gave back, to the shareholders in dividends, but they also invested in research. And back in 2010, they were talking about low-flying satellites, for Microsoft, and I thought they would get into that, but they never did. But they're into the AI right now, and it's actually a deployable product. I thought that was impressive. So they continue to reward shareholders with innovation and new products. So I think that's a good reason that it could be a stock you hold for a long time. And Microsoft also, they reinvent themselves. A good company reinvents themselves. They have gaming. They just made Xbox out of thin air, and it's a good contributor to their company now. And they do that with other products like the cloud and now this ChatGPT AI. So let's look at some other companies. Pepsi. We were talking last week that Pepsi was nearing the bottom of its trading range, and it was pretty much oversold. And now I guess what's happening is it's starting to go up right here, and then it's going to go down. So this Pepsi is like a long-term, it's like a compounder for me. It's only growing at 3%, but they have like a 3% dividend, so you get like a 6% total return over time. So I've held that since like 2011 or something, and it's one of those things I know I'm getting a dividend, and they're constantly innovative, and there's a large demand for their product over time. And that's why Warren Buffett likes it. He knows that people are still going to be drinking Coke 20 years from now. Okay, Procter & Gamble. This follows the pattern of all the dividend stocks we're following. It's just stuck in our trading range. In Starbucks, this is one of the ones that's been going up for the longest. It's at the bottom of its range right now, but it's super pricey, expensive. Okay, you can see Amgen is one of the drug stocks that is out of favor right now. Drugs are not a popular thing to invest in, and so almost every one of these drug stocks are going down. See, healthcare stocks. CVS is an example of a healthcare stock. We were talking about United Health last week, and United Health had a really bad news recently that people that deferred operations during the pandemic are starting to get operations now, and that's going to reduce their profitability, and that'll affect every one of the insurers. Every one of the insurers went down after that news. So, but what I'll do is I'll go to another news story. See. Oh, here it is. Mercedes, that's the company. Mercedes is bringing ChatGPT into its cars. I thought that was a huge story, that ChatGPT is an actual product, and Microsoft's going to make money from that. That's so Microsoft is going to make advertising money from that, and they're going to generate. They're becoming a Priceline. They're becoming a company that you can go Expedia. You can go and have a vacation made for you while you're driving, and so they're turning themselves into a product recommender or advertising from the car. That's something new. So Mercedes, they decided to add it to their new cars in the United States. It's the generative artificial intelligence software, so you can realistically talk to a human dialogue to the computer. And ChatGPT will make these voice commands more fluid and natural, so it's more than drive to Barnes & Noble. No, it's not that. It's could you make a vacation for me and have someone pick me up at the airport, and we'll see if that actually works. It seems like it's in beta testing phase, but I guess it isn't. Okay, so that was a good news story. Let me go through some of the other things we're talking about here. Okay. Okay, so for the S&P 500, we're at 96 right now. That is as overbought as you can get. I don't know when the last time we had such a long period of time. Maybe after the pandemic was over and we had the stimulus, we had a period of time like this, but it's pretty overextended by any means. Everyone says that on the TV. So it's very dangerous to put new money in right now. One thing that came out this week is inflation is currently at 4% year over year. And so that means that I guess what we're looking in this plot right here, we have 4% right there. So things are coming down pretty exponentially every month. So the next plot is probably going to be 3.3, and 2 is the target. So when it hits 2, then the Fed will be happy because that's their target rate. So then the stock market will probably have no reason to fear the Fed anymore. And then we don't have to look at the 2-year and the 10-year anymore. So the U.S. dollar index, it's up a little bit, so we can't really say anything from that. It's only up 1%, and gold is down 1%. So when the stock market goes up, people aren't really gravitating to something that's conservative and safe. So that's probably what's down. Fear and greed. We're getting greedier every week. So we have a fear of missing out. We have extreme greed right now. Last week it was 76. So it was greed. It was like extreme greed, but a little bit less. So we have this. You have to think as a contrarian if you're putting new money in. Right now we have everyone excited, and you think it's going to keep going up, the average investor. But in reality, this is when you hit a brick wall and things go down again. So you just have to think about what's going to cause the next thing to go down. Anyone have any ideas? What could be the next thing to happen in the stock market? Right now, we've had this theme of the Fed, raising interest rates, and then we had the war. These are big themes. Anything else that might happen in the summertime that?
Well, there's commercial real estate. I think that there's going to be a lot of REITs of commercial real estate are not in probably good shape. There's we're going to have leases not being renewed. I think that can also roll over into the banking sector and like the loans against these buildings.
Mm-hmm.
So that's one thing that's on my radar.
Right. So let's say we have another mini banking crisis. Maybe a bank was overextended in some of its commercial loans, and it needs to be bought out by another bank or something like that. Or the fear of something like that happen could make the stock market go down. We see just today in the stock market, we see in the sector ETFs, the regional banking ETF, going down. Maybe that's an indication and like a canary in a coal mine that the stock market thinks that could be the next thing, right? And we have retail ETF. We possibly have, no, we can't put those two together. But yeah, I think that is definitely something that we should be fearful for in the summer. Is there anything else that could cause problems in the summertime? In the summertime, it's a pretty dull time. A lot of the traders are off. They're on vacation. It's low volume. There's not as much, activity. So you have that, and you don't have right now. We don't have the next quarter, the earnings reports for a couple months. So we have to sift through a period of time with no news. So that's something to think about too. Anything else anyone can think of? All right. Let's go to the next thing here. The VIX is down. This is probably the lowest it's been since pre-COVID. Whenever the VIX is down to the lowest amount, people are not afraid. They are in bull mode. But that's the exact time when things start going down in the stock market. So we have the complacency, and people are not afraid, and they're probably borrowing on margin and buying crazy things that are going up. We do though have institutional money chasing the highest, the best, the companies that did the best this quarter, so they can look good. That's going to happen in the next week. So we have to keep in mind we do have that artificial push on the market. Let's look at some of the valuations. Right now we're basically here at the top, the new paradigm, AI mania, and it keeps going up more and more. But the smart people on TV, this is whenever the traders feed the ducks. They feed the ducks, meaning they give, whenever people are buying at the top, they sell, and then whenever people are in despair, this is the time that the traders start buying. So it's very dangerous to buy calls right now if you're an option person, and it's because that's just the time when the fear comes into the market. Okay, so let's look at this is a very important news story. Could you hold on for 1 second? So the S&P has gone up like let me see, 15, 13 or something like that percent this year, but 90% of those gains has been from top 7 stocks. And everyone on TV has been saying this all year long, and finally we have a little bit of the rest of the stocks in the S&P starting to gain momentum. And the important thing is how many of these stocks, I couldn't find it before the talk, but how many of these stocks in the stock market are actually above their 50-day moving average, 200-day moving average. And that's when you get the true momentum in the stock market. So if we look at the S&P, we're stuck right now in this range, in this range here. But if we get more and more participation from all participants, and you can see these moving averages we have here. They're kind of small, but you can see they're colored, coordinated. 200-day is purple. So you can see the S&P went by the 200-day moving average right here, and the 300-day is 400 right here. So the S&P went over the 400 day moving average there, but not all stocks. And this is because of the top 10, 20 stocks. Now we're getting other stocks in the stock market to go over their moving averages, and that allows us to resume this higher high, higher low pattern. And that's pretty important. And this article just came out today that the other S&P 500 stocks are starting to participate in the rally. So that's really good for breadth. Breadth allows momentum to happen. Now let's look at, okay, so stock rally is deepening beyond the AI-fueled craze. So let's see. You can see that this trader, this guy from, I forget what company he's from, I think Morgan Stanley, he said, all this being said, our concerns grow that the leadership areas like NASDAQ 100 and S&P 500 remain overbought, extended on a short-term basis. We've been saying that for 2 weeks now. While we understand that overbought conditions can last for some time, we understand that historical data illustrates they cannot be sustained indefinitely. So every trader knows this and knows we're peaking out right now. So it seems like we're due for a pullback, and you see, that's just something you gotta have a mentality of understanding the ups and downs and be willing to hold through all that, and know there's just a portion of the market that makes money on the ups and the downs, and it's automated, and you have to deal with that. And I think every stock market participant looks at this chart, the S&P, knows where we're at, and knows it's time to sell when we get to the overbought state. So you have to be ready and willing to hold through the downturns. All right, so let me see. We already talked about this. Okay, so we have some people, more than one. I mean, there are a good number of people on Twitter, a good number of people that have predicted the 2008 crash, say that there's a resemblance to the 2008 period where we had a financial crisis, and that was followed by a 20% gain, and then we had a crash of 40%. So, whatever we're at right now, if we look at the S&P, okay, let's look right now. We have zero growth in the S&P right now, but we're making pretty much a high, highs. There's a very good chance that we could go down more, just because we're still in a phase of taking money out of the market with the Fed. They're not buying bonds anymore, and they're letting them expire. And we have the interest rates, which might be raised 2 more times. So there's a very good chance, if the stock market falls, we have to look at prior levels of support. So right now we're right here, right there. So we're getting to a point where if we reach, this is like a level of resistance. This is level of resistance. Then you have, if you start falling in the stock market, you have to look for levels of support. First level is like right here, then right here, where we were here, and then here. Then if it falls more than that, maybe on some kind of bank failures, we'll go down to here and then down to here. But if that ever happens, then you have to know that every time it falls, it usually recovers within a couple months. And it's not in your best interest to sell on the way down. So right now we're pretty much at a overbought state. So if you're afraid of it going down like that, now's the time to sell some of your positions and get ready for that. I have like an unlimited amount of pain to endure going up and down because I've already held long enough where it doesn't matter to me. All right. So we have a lot of inflows into the stock market recently. So that's great. The more money that comes in, the more the stocks go up. And utilities led outflows. That's why the utilities is not doing too good in the ETF chart we were following. So it's all about flow of money. And let me see. Okay, so that's all we can get from that article.
So, Greg, did you ever look at like the S&P 500 PE ratio? So you brought up that chart before. You were just the S&P 500. So like I think a PE ratio chart can also be interesting in terms of like how, because looking at the log chart for the S&P 500 doesn't really show you necessarily the valuation versus how much they're earning, right?
Yes.
So I think that can be another way to.
Let's look at the S&P P ratio. The average is like 15 over time, the last 20 years. And then if you go back 50 years, it's like 12 or something like that. It's hard. Let me see.
I think the average is higher than 15 based on the last 20 years. If you pulled that chart you just have there, click on that 20-year button there.
Oh yeah, 20 years. There it is. Okay, so we have.
This is a log scale also in general.
I can't understand that as well. Log scale.
You can unclick the log scale if you want to see it.
Okay, so we have show recessions. All right, so recessions. Okay, this is a recessionary time. Then we got a fraction of a recessionary time here. So the average is, the lowest is around 13. The average is around.
I think it's a lot of time at like 19 or 20. Yeah.
Yeah. So we're right around right now.
Yeah, we're on the high end of the last like 10 years or so.
Yeah. Okay. So we're still trading at a premium.
Yeah.
If you return to the mean, we're going down. Let's say we're at 23. Wait. We're at 24 right now. Let's say even number. Let's say 20. Usually things return to the mean. So if we do 20.
Which is either the earnings will go up or the price will come down. I think the prices might come down a little bit.
Okay, that's 25% from a P of 18, which is, let's say, normal. Let's say, see right there, that's probably the median. That's probably 20. Let's say 20. And right now we're at 24. So let's go 20 divided by 24. It's like 17% drop from where we're at now. So we can easily drop 20% in the stock market and still be fairly valued.
Yeah.
And so you have to look at the when you look at the stock market over time. Let's do that real quick.
Because I'm not sure. I think that companies' earnings have gone up quite a bit recently, right? So I don't think that we're going to see a bunch of earnings expansion.
Yeah, it doesn't seem like we're having the E part of the PE isn't changing, and the price is going up, so it's getting a little bit more dangerous. The hard thing is, a lot of people are saying we're kind of going into a mild recession. Even if we do, the recessions that we've had weren't dramatically hurting the stocks. It just, for a period of 1 or 2 years, they were not as profitable, and then they get back to where they were before. So yeah, it seems like right now things are pretty expensive. Right now the PE is, right now the stock market's kind of flat. I don't know. I don't know what I was trying to say there. Let's go back to. All right. Well, I think it's going to be hard for the S&P to go up this year because in general the earnings aren't going up a whole lot. You have momentum, and you have fear of missing out. Those are two things that are hard to fight. But for new money, it's really hard to put in at fresh highs. So that's all right. So let's go on to another little topic here. Last week we mentioned that GM is to use the Tesla charging network. Okay, so that was a great story. We didn't really see, that could mean that Tesla becomes a juggernaut in the energy for cars in America. It could be a standard, and they could license their technology, and that could be a whole new set of money coming in for Tesla we didn't know about. One thing, that news story that came out this week is Tesla is offering free supercharging to entice Model 3 buyers. So if Tesla can find a way to have, let's say some of their solar panels powering this charging network, basically they're getting their product for free. They're getting their product for free, and if they can, with maybe maintenance of these charging stations, and they could use it as a monetary incentive to buy their cars. Let's say you can have free charging on our network for 3 years, which is worth something to people. That could be a way to differentiate their product from other car manufacturers. So that, I thought that was a pretty neat article. And let me see. So they offer 3 months. It's not that much, but 3 months of charging free to buy a Model S. They're trying to clear out. Model 3 they're trying to clear out. So that was. But what I did, remember last week I said, well, I wonder what that news story would affect, how that would affect their earnings projections. It didn't a whole lot. They've increased a little bit. You can see from 87 cents to 88. It didn't really, I expected it to be like maybe 20% higher if they're becoming an energy company now. That didn't change at all. So we'll have to check on this in a month. Maybe it'll take a while for people to figure out what that charging network is worth. Okay, this Jeremy Siegel, he's been pretty close. He's been the closest prognosticator on CNBC that I found that matches what eventually happens. He said the stock rally will end soon, recession will hit, and the Fed won't raise interest hikes anymore. And he's been saying for like all year long that the Fed is raising rates and the economy is actually already slowed down. So we have to be ready for that right now. We're overextended in the stock market, so you have to be very careful not. This is probably what's going to happen. We're probably going to go sideways the rest of the year. He said that both the .com and housing crashes, stocks rebounded over 20% and then erased all those gains. Another guy saying this. So he has some really smart people. This is a guy who's like a Wharton professor. So he really knows his economics pretty good. So you have to be ready for that, and you just can't get overextended right now. All right. All right. So this article here, we were following United Health last week. We actually went over the fundamentals, and we said it was pricey because we were looking at, where it was trading at. It was trading at like 1.83 times overvalued as of last week because it's not going up. If the PE is 20, and it's growing at 10. That's like it's double the valuation it really should be. And he gave a news story about, there's a possibly a surge of surgeries where people are getting their surgeries now that will reduce their profitability. So I thought it'd be interesting to look at the chart of United. Actually, follow this. United Health is the largest health provider in America, and it's been a reliable growth stock over time. It's been one of the best performing stocks, and because of that, it probably trades at a premium. But you can see that, we have this trading range that's been well established, and it went down exactly to the penny to the bottom of that trading range. So it's almost oversold. It's halfway oversold in the stochastics. But, in any bad market, you can see it going down to this next level of support down here. And probably if it went the whole way down to this lower level, that probably make it a peg ratio of 1, and that would make it like a fairly valued stock, and that you can start dollar costing into it then for a fairly valued growth stock. I think this is a stock that will grow like 12 or 15% a year. But right now it's just overvalued. Any bad news usually takes a stock down to a prior level of support. So you have to watch these. If it has any more bad news or other companies say similar things in the industry, it might go down to these levels, and then we can follow up and see if it's fairly valued yet. Let me see. Right. Where are we at? Hey, we're almost at the time. We're almost at time. Do you have any questions? Anyone want to go over anything? Do you have any thoughts on the stock market or something you want to go over? I'd say that's a no. All right. Well, thank you very much for attending, everybody. I hope you have a good weekend, and I'll see you next time.